Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
The popping of the speculative bubble. Now, the other thing that a lot of government agencies had talked about was possibly bringing in some regulation of all the speculation that was going on with energy futures or energy ETFs because of the fact that they believed that a lot of hedge funds and a lot of just institutional money, if you will, was in energy-related products. Now, with that being said, I'm sure there was definitely a case for it. One of the things that happened during that time is margin requirements were actually raised for crude oil futures. You didn't have the same leverage that you once did as it went higher. So, from a standpoint of a dollar-based margin requirement on the oil future side of it. So with that you could make a case that that was one reason as to why things came down. As well, the fact that, number one, the government looked like they were going to step in. Maybe they were going to, maybe they weren't, who knows. But the fact that a lot of institutional money may have come out of energy-related products, that could have definitely been another reason as to why gas came down. Dropping of interest rates. This was definitely a historical time of interest rates as well. In January of 2007, the 2-year U.S. Treasury note was at 4.76%. In May of 2009, that same Treasury was at 0.92%. So with that, I think it's fair, everyone would agree that we dropped interest rates quite a bit during that time frame. And right or wrong, I'm not trying to get political on you here, but right or wrong, this definitely had an effect on the economy in general. You could argue and say that this stopped the bleeding, or this slowed down the bleeding, if you will. Now, whether it's going to be good for the long term or not, that remains to be seen. But this is another factor as to how prices actually affected prices in general, not just oil, but in the entire economy. Now, the other thing that happened, we had a housing bubble at this stage in time that was actually popping. No one could sell the house. And I was actually part of that housing bubble myself personally, in that I had 2 houses, one of which I did not want for a period of 13 months. This is a very crazy time in U.S. history. Now, finally, let's talk about how this is in relation to currency values. BPX is the ISE's U.S. dollar British pound index. So if you have an opinion on the British pound and you want to trade options on it through the ISE products, BPX is that specific underlying. It's U.S. dollar based. So if BPX goes down, that means that the U.S. dollar goes down. If BPX goes up, that means that the U.S. dollar goes up in relation to the British pound. So looking at this, the U.S. dollar rose from 50.37 to 66.8 during that time frame with which we're discussing. That's a 32% increase. That's quite a bit. Now, the question that I pose to you is the rise in the U.S. dollar related to the decline in gas prices? Maybe. Just like with anything, maybe is the answer. There is no sure way of knowing this. But with that being said, you could argue that commodities did cause the flight to safety in the U.S. dollar. One theory that you could say is that when, we've probably heard the statement before, when the U.S. sneezes, the whole world gets a cold. But here's a thought to think on this. Obviously, we went through a recession recently, and maybe we're still in it. Who knows? That remains to be seen. But the point that I want to make is that when people are scared, a lot of times they will flee to safety in the U.S. dollar. So because the U.S. dollar has risen, that you could argue and say that that has taken money out of the commodities and put it into the U.S. Treasuries. Because if you look at what the 10-year note did recently, if you look at what the 30-year Treasury did recently, up until the beginning of this year, we had quite the bubble in the U.S. Treasuries. Look at a chart of TLT sometime when you are looking at a chart for TLT, that is the ETF that tracks the longer-term U.S. Treasuries. Look at how it peaked right at the beginning of the year for 2009, right around the January 1st, December 31st time frame. It was very high, and it's come down quite a bit, but it was up there. Now, the other thought is that maybe the other reason why it came down would be lesser demand caused the dollar to rise, oil to fall, gold to rise, silver to stabilize, and the stock market to tank. Who knows? This is the bottom line. Currency plays a role in everything. Oil is measured in U.S. dollars, and the fact that the dollar was going down so significantly, I believe that played at least somewhat of a factor in oil going down like it did. The dollar definitely went up. Now, how does this actually play a role in everything? Well, let's take a look at the rate of return of the S&P 500. Since 1985, this is just a general chart, since 1985 till about May of this year approximately, the S&P moved from 165 to 900. If you annualize that, that's about a 7.65% rate of return every year. Now, that's if you invest in dollars. That's based upon buying power that I have in the United States. But what about pounds? Let's just look at the British pound and see how it actually worked with that. Based upon the ISE index, the U.S. dollar was at 0.95 back in 1985. So the ISE BPX options were not around back in 1985, nor was the ISE for that matter. But if you actually do the math and calculate these things back to 1985, the U.S. dollar was worth 0.95 in relation to the British pound. In 2009, it's at 0.66. So what does that mean? Well, the first thing that it means is it's darn expensive to go over to London on either a business trip or a vacation. I was actually in London about a little over a year ago, and I remember paying $75 US for just a dinner at a Marriott-style hotel. It's not cheap over there, but very nice people, I must say that. This means that because the U.S. dollar's declined over 30% in that time frame, that it's not going to be the same buying power if you live in Britain as if you do in the United States. Me personally, because I live in the United States, if I would have invested in the S&P 500 back in 1985 and just on a buy and hold strategy for that entire time, I would have made my 7.65%. However, by measuring this by the standard of the British, because they use pounds, the rate of return is only 5.75%. That's about a 2% difference, and that's annualized 2% difference. Now, by doing the math on that, you're going to be pretty upset with that if you were expecting to get a higher rate of return than if you're a Brit just based upon the currency going against you. So, today's webinar is about hedging your life, but part of your life, and for a lot of people, a big part of your life is your investment portfolio. We're going to talk about that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.